How do you build a great stock portfolio using a trader mindset? Today, we'll speak with someone who has been successful as an investor and a trader about how to use proven trading tools while also focusing on the long term. Plus, she'll tell us about 9 stocks that fit into her strategy. So let's get started. This is Ticker Take.
John, before we get into today's list of stocks, we often hear about the differences between being a trader and being a long-term investor. Well, our guest today has experience in both arenas.
True, Caroline. Yeah, we're talking about Diana Avigdor of Barometer Capital Management. And because she's had success as an investor and a trader, she has great insights on how you can stay on the right long-term path while using skills you can learn as a trader.
All right, let's get some more perspective from Diana.
Diana, it's great to see you. Thanks for joining us on Ticker Take.
Thanks for having me.
You have a saying that price action has to fit the narrative. Now, as someone who has had success as a trader and a long-term investor, what do you mean by that?
You know, so many things have to go right. So there's different ways to make money. You can buy low value companies and then, wait for a long time until they work, and hopefully they do work for you. For us, it's a bit of risk management strategy. We look at the fundamentals. Actually, we take it from the top. First of all, do you want to be invested? Is the world a good place to be invested? And then trickle down into sectors, and then trickle down through fundamentals to the stocks. But if the price action, if you think a company is doing so well, if you've analyzed it, if everything is great and the narrative is wonderful and it's not acting well, then you might be missing something. We don't dig in our heels to say we're right, the market's wrong. We're going to wait for that price action to work. And there's many examples where you could have been invested for a very, very long time, and it's a bit of an opportunity cost to not look at it that way. And sure, you miss the bottom, and sure, you miss the top, but do you ever get the bottom, and do you ever get the top?
Good questions.
Right?
Yeah. So just as an example, in this cycle, a stock like Celestica, this is a stock that had a huge run on AI excitement, and you benefited from that, but eventually you decided that the price action was no longer fitting the narrative. Is that correct?
Yeah, we were in Celestica for a long time, and we've made some nice money. And so here is the thing where you miss the top, I guess. They reported great numbers. And their networking company, it feeds into the AI hyperscalers, and we know that they are not stopping to spend. And the quarter before that, when the CapEx was announced by the hyperscalers, this stock actually reacted positively. This time around, they reported these great numbers. Hyperscalers were starting to report great CapEx, large CapEx numbers. Whatever, they traded up, traded down, that's a different conversation. But Celestica should have reacted positively. Now, they also announced that they're going to have some spending, but they're funding it from their operating cash flow. That should have been okay. In a market that likes tech, in a market that loves what's going on and wants to price that in, Celestica should have traded up. The day after they reported, they were trading down 12%. I was asked, would you buy it now? And I said, no. And they said, but you own it. I said, yes, but we're very close. It's a 1-yard line. If this stock is not going to act well, we're going to find a place where we're going to just get out of the stock, because obviously the market's pricing in something else. It's not giving us something. So the quarter was great. So we're out of the stock now.
All right. With all that said, Diana has 9 stocks to walk us through. But first, a friendly reminder, this is not financial advice. Stock number 1. Lam Research.
Well, this is a much talked about stock during the recent boom. It's had a big run. Analysts still are pretty supportive of Lam, but give us your take on the company.
Analysts are still very supportive of all tech. And some stocks have really come off highs. Like the S&P is almost at highs. We have Microsoft off, Nvidia off, with the exception of Micron, that's rallied. Chip companies. Okay. So Lam Research, it's a semi-cap equipment stock. It makes processes that allows chip makers to make chips. So obviously lots of demand. They just reported a little while ago excellent numbers. They're sporting margins of close to 50%. And certainly their customer demand is very large based on what the reports were. Bottom line, and more importantly, the guidance was excellent, and the stock market rewards them for it. It did not sell off. Its chart looks excellent. It has not broken down. It continues to power ahead. And it has been doing so for a very long time. Nvidia, if you look at its chart, it's had its hiccups throughout the last few years. Lam Research just nice and steadily going up. And so far so good. Fundamentals are great. Chart looks good. Price fits narrative.
Stock number 2, Alphabet.
Alphabet, a stock that was a hero in 2025, had this big run. And I guess even though it remains a well-liked stock, you said tech generally still gets a lot of thumbs up on Wall Street. What is it about Alphabet that still keeps it on your list, so to speak?
So Alphabet just reported $400 billion in revenue. If anyone can benefit from AI productivity gains, I guess it is one of those through search and all the other stuff that they're doing. They also said that they could spend $180 billion in CapEx. Could doesn't mean will. Could means could, but it's still a big, big, big number. Stock's not acting the same way as some other stocks in terms of its chart. Price action. Price action, fits narrative, but so. So we're watching it very carefully. A little while ago, we spoke that we exited Celestica for the fact that it did not act right. I hope Google acts right. But at some point, if it doesn't, that we will be looking to exit and see what's happening. The quarter was excellent. $180 billion in CapEx is a huge amount of money. They're all toppling over each other. They know that, the first achiever gets it all type of thing. So they're all over trying to outdo each other in CapEx spending. Who knows if it's going to pan out or not, if they're going to actually spend that kind of money. Could is not will, again. But the stock's acting so far as it's holding in. We're still in there. But yeah, we'll see.
Stock number 3, Nvidia.
I'm glad we're talking about Nvidia because, as someone who has been a successful long-term investor and a trader and uses price action to decide if the narrative is still working, I think a lot of people want to know, is the narrative going to work for Nvidia going forward? How do you think about it?
So who knows? We've owned Nvidia since 2023 till today. There were a few months in between 23 to today where the narrative and the price did not match. And so we were out at the time. And then when they re-meet, we get back in because it's a great story. It is the father, mother, grandfather, grandmother of AI here. Right. So you want to be involved if you think that this is the next thing that's happening in our lives. We'll see if the narrative and the price action continues to work together. It was a little bit touch and go a little while ago, just recently. It did not break down, but we certainly had our heads together and thought, is this not going to work out? Are we going to get stopped out? Some of this trading strategy around, price has to match narrative is also a risk management tactic. You don't want to dig in your heels and say, you're right, the market's wrong. You're going to be right, and that's it. If it doesn't act well, we're not going to stay there. And Nvidia will be the same thing. But, expectations are great. It's not expensive. For those that like to compare today to 2000, these companies make an immense amount of money, and they're not trading as expensive as they did. They have earnings. Companies in the dot-com bubble did not have earnings. These guys have a lot of earnings, and they spend a lot of money.
Stock number 4, Caterpillar.
Now we're moving into definitely not a traditional tech play, although a company that seems to be benefiting from all this AI stuff, and a stock that is generally well-liked on Wall Street. What's your take on Caterpillar?
Caterpillar is an industrial and industrials have been doing really well. These are the real economy stocks. And they've been acting much better than the tech lately, actually. That's where the money is rotating into. Like it or not, the U.S. economy is inflecting upwards. And this whole commodity move of late has also benefited these companies. And they're right in the cycle where all these miners, now 12 to 18 months into their growth, probably going to need some machinery. But it's also an AI play because Caterpillar makes these natural gas turbines going into the data centers. You know, the data centers that are so needed in order for all this AI to work. They reported recently their backlog was a record $51 billion. And they grew their energy segment by 44%. Their profit grew in that segment 44%. So they're looking, and then their guidance, they said they're going to double this business. This is a very fast growing business and it's very high margin. So, Caterpillar beats revenue, earnings, guidance was excellent. It's a real economy stock, also with a little sleeve into this AI, that gives it a little bit extra oomph. And the stock is acting very well.
Stock number 5, Morgan Stanley.
Okay, overall Wall Street, a bit mixed on Morgan Stanley, but for the long-term investment part of what you're doing, there's a thematic idea here, correct?
Yes. So there's two things. The larger economy, and capital markets. So we at Barometer think that the global economy and the global markets are finally working. Look what the TSX did. Last year was up 30%. Look what Europe, Asia, global markets are finally working. Portfolio diversification is finally a real thing. You didn't just have to be in the U.S. This creates a lot of capital markets lubrication, whether it's IPOs, exits from private equity, all that kind of stuff. Morgan Stanley is the epicenter at that. Also retail. There is more retail engagement in capital markets than ever. All you ever hear is retail activity, retail flow. You have all these brokerages coming up. Retail, the regular person is more and more interested in capital markets than ever. Morgan Stanley has a huge retail network, a huge wealth management arm, and they're doing very, very well because of these reasons. Not to mention the U.S. economy also inflecting upwards.
Stock number 6, JPMorgan.
Okay, well, JPMorgan, I guess if you look at the analyst views, scores a little bit more favorably than Morgan Stanley. I think that's just, it's seen as the gold standard of the big players on Wall Street. Again, thematically similar to Morgan Stanley. What's the JPMorgan perspective for you?
Similar to Morgan Stanley, if you take the macro and you take the capital markets side of things, but it's also the largest, most premier bank, which is what you just said, and it acts a bit of a hedge, really, in the financial book. We own several banks. This is in the U.S. We own some Canadian ones and European ones. It's part of a bigger picture. So JPMorgan as the premier company really acts a bit of a hedge in case things get a little volatile.
Stock number 7, M&T Bank.
Okay, now, Diana, we're moving into some what are described as the regional banks. M&T, an example of that. How come? What is it about that one that stands out?
So the difference between regionals to, say, money center banks and JPMorgans of the world is that they're closer to the local economy. And so if you have an administration that is pro-business, pro-small business, and you have a Fed chair, for example, that was just announced, that comes in that is wanting to decrease the balance sheet of the Fed, somebody has to take that up a little bit so that liquidity doesn't really dry off, because there's a reason why the Fed has such a big balance sheet. So deregulation would benefit all financials, really, but to the extent that it will promote local business and these regionals are close to the local business, they're going to see loan growth, and economic development. So we have the macro, with the economy inflecting, we have deregulation, and we have lower Fed balance sheet. So all of this kind of plays in, less so on the retail capital market side that, say, Morgan Stanley has, but more on the local business development.
Stock number 8, Regions Financial.
Okay, so I assume with Regions, this is sticking with the regional bank theme. There's value in holding multiple names tied to sort of a broader theme in your portfolio?
Yeah, you have a portfolio. You don't want to overweight, more than a certain percentage of a client portfolio. So you run a portfolio of several, of this theme and several of that theme, just like we have Morgan Stanley, JPMorgan, we have MTB and Regions Financial. These are two premier regional banks. They're fairly large. There's much, much smaller ones, more localized, but these are a little larger ones, and they fit into a portfolio in the right way and with the right price action.
And stock number 9, Agnico Eagle Mines.
Well, we're going to end with a gold miner, but there's some context here because we've talked about how you are investing for the long term, but you're ready to pivot based on what the trading signals are. And you guys were very early on gold. We've spoken with your colleague, David Burrows, as well. You have taken profits on gold and silver, but Agnico you still have for right now. So give us a perspective on why.
Thanks for that introduction. That's perfect. Yes, we were in the gold and silver trade very early. The theme was reflation and generational low in rates. When rates started to pivot upwards and the US dollar started losing its strength based on the new administration wanting a lower dollar, given the fact that they have to refinance $9 trillion worth of debt. So they need a lower rates, lower dollar for the everything that they're trying to do, locally, bring back manufacturing and so forth. So, gold and silver started acting the way it does, and we do our breadth indicators, and we started to see what was happening there. So yes, we were in. But it rallied a lot. Silver, for example, rallied 30% in 14 days, and then lost the same 30% in one day. When you start seeing that kind of face-ripping volatility, some of the stocks don't act well. And as you know, one of our major themes is that price has to fit narrative. And we've been very vocal about the fact that given where and how extended things were, that at the first sign of a break, we were going to do some risk management, rehauling. We're going to take some profits, and we're going to exit. And we did that. What we kept was Agnico Eagle. Agnico Eagle is a large cap company with production and revenue coming from geopolitically safe areas. So they're in Canada, Mexico, Finland, Australia. There is no worry in any of these places that something happens to their people or their mines. They're cost cutting, or rather they're very careful with their costs. They're paying down debt. They're paying a dividend. So this is a mature, large cap company that, sure, it has to act the way we need it to act, but for now it's still in the portfolio. And I would just say we're not off the reflationary theme. So we may very well re-enter should things subside in volatility. Maybe soon, maybe later, but we're still watching this trade very carefully.
Really helpful context, both from a long-term investing and also from a trading perspective as well, Diana. Thank you so much for your time.
It's my pleasure.
Thanks for watching here on the BNN Bloomberg YouTube channel. Ticker Take has its own YouTube channel, and you can find a link in the description below.
See you next time.